All right, tonight's webinar is part one of the coming storm, and we chose that title kind of carefully, but it has meaning. There's a lot going on in Washington, and a lot of this you need to know about for the coming year and for the end of this year. I'm Tyler Henning. I'm fairly new here. I'm the marketing manager, and of course, with me is David Apper, our founder.
Hello, everyone.
Tonight, we're going to go through a lot of material. We're going to look at the pending tax legislation in Washington, what we think is coming, what we know is coming, and what might happen, and some steps that you should consider doing now to offset the things that we're seeing in legislation, whether it's been passed or whether it's waiting on a vote.
So real quickly, everything we're going to talk about today is based on these potentially new laws. We're going to obviously throw out some suggestions about things that might end up changing. Anything we provide is not intended to be, specific tax advice. You certainly should get advice from your tax advisor, or certainly we can. You'll be engaged to be able to provide specific recommendations in your situation. So just be careful when you hear the information today, because a lot of this is just still pending and isn't actually signed into law yet.
Well, one of the favorite things that we have, our favorite sayings around the office, is the hardest thing in the world to understand is the income tax, and what's going on in Washington right now kind of has that same feel to it. They're just adding more and more pages to the tax code and adding more and more wrinkles to it.
Yeah, the rumor has it that he said that quote back in 1935.
And that was when it was closer to a 400-page tax code, I think. But he had a vision for the future, and he probably saw what was coming.
Exactly.
One of the things that we always like to reference on our webinars is our model. Whether you are a current client or someone that's considering Provident CPAs and physician tax solutions, this is our model. You're going to hear it a lot with us in our onboarding, but it kind of correlates to Maslow's hierarchy of needs. We feel that these are the steps to kind of get you to financial independence. Each one is important. We start with saving, and I kind of, with our bread and butter, our tax planning, tax minimization, and we build on that through some different levels. Our process starts with a strategic blueprint, and we will talk a little bit more about that. We have an outstanding onboarding process where our team will talk with you and go through an education process. It's pretty special. The implementation is what you saw previously in that model. And then the quarterly pulse is something that I think is amazing. I've formerly been a business owner, and I always wondered what kind of ideas my accountant should have for me, but they were pretty reactive and not proactive. So I never heard from them except for tax time. But this quarterly pulse is the kind of thing that's going to have you thinking and considering moves that can be made and moves that need to be made. I want to hand it over to you, David.
Great. Thanks, Tyler. So first thing we want to talk about is an overview at a very high level. So again, a lot of this is still in negotiations right now, but we wanted to get ahead of this. We're here in the first week of October 2021. A lot of things could happen over a short period of time. So what we've done, and we'll talk a little bit more about this at the end, we've scheduled 4 webinars 2 weeks apart, so that we can start the building blocks of understanding what the pending legislation is, plus as it starts being passed by the House and the Senate and signed into law, you will know in advance what steps you're going to need to take, rather than how a lot of people are going to hear about this is late in December and possibly not until next year, and the window would have closed to do anything about some of these tax law changes that are going to change this year. So the goal today is to talk at a high level about some of these changes, get you to start thinking about how it might apply to your own situation. We're going to cover 4 different pieces of legislation in somewhat in sequence of how they've been introduced. So the first one we're going to talk about is the bipartisan infrastructure framework. So if you remember, back in the summertime, there was a kind of discussed in the press a part one and a part two. So part one is this infrastructure bill that had bipartisan support by a handful of senators and representatives. It then proposed a $1.2 trillion spending plan. In between, while that was finishing negotiation, by executive order, the president passed or put some COVID changes in place that related to the PPP loan and EIDL loan that may apply to several of you. And then most significantly, and the one that now is in the press, is the Buildback Better Act. That was just released by the House Ways and Means Committee 3 weeks ago. It's now being heavily debated. And hopefully we'll know something here in about 2 or 3 weeks of whether there'll be an agreement on that act. And then the last one I want to mention, just because it could be right around the corner, and that is there's a bill that's in both the House and the Senate called the Ultra Millionaire Act of 2021, and it has some additional tax changes that may apply to you, if not now, sometime in the future. So we're going to go through these at a high level. So the first one is this bipartisan infrastructure bill. So if you remember back in June and July, this was agreed to by both the House and the Senate, and along with the president. It was a $550 billion federal investment in new infrastructure in the U.S., which basically is going to include the largest federal investment ever made in public transportation, the largest investment in passenger train or railroad since the creation of Amtrak. It's going to have the largest dedicated bridge investment ever since the construction of the interstate highway system. It's going to change, or it's going to have significant investment in clean drinking water and wastewater infrastructure. It's going to allow every American to have access to high-speed internet, and it's going to have a significant investment in climate change investments that we've never seen before in the history of the U.S. So a lot of money being spent on infrastructure, supposedly with a lot of job creation over the next 10 years. So a lot of this is intended to put in money into infrastructure that ultimately creates jobs. So that's one bill, and I would say that that's one of the stronger bills out there because it is somewhat has bipartisan support. However, it's still going through negotiation. The other piece that happened while that infrastructure bill was being negotiated, the White House passed by executive order changes in the PPP and the EIDL loan. So one of the changes that was made was lifting the $500,000 cap on the EIDL loan, the economic injury disaster loan, back at the beginning of 2020 when that program was started, up to $2 million. And then it made it easier for certain industries or businesses to get some additional help. So those changes just came out about a month ago. So if you're not aware of those, you'll make sure to see if those could be helpful for you. And certainly if you need help identifying if those are possible options, that we're certainly here to help walk you through that. The next bill that is really the concentration of today's presentation, and we're going to treat this somewhat as an onion, where we're going to peel back some of the layers tonight and talk about some of the significant changes in this new act that came out of the proposed by the House Ways and Means Committee. It's now in front of the House to be voted on, but it's the Buildback Better Act. And it has a proposed $3.5 trillion spending plan associated with it. As you probably read in the press, there's been quite a bit of debate and ruckus about this on Capitol Hill. It's now in front of the House to be, so it's still pending. It's not yet been voted on. It's basically designed to help implement all the recommendations that President Biden had in his American Families Plan and American Jobs Plan. Just as a reference, if you want to think about how big this bill is in terms of spending. Compared to all other tax bills that have ever come out of the Congress and the Senate, or the House and the Senate, as a percentage of gross national product, this is the largest gross tax increase since 1968. And if you remember back, if you look at the history of tax rates, that was back when the marginal tax rate was hovering right around 80 to 90%. So we'll talk a little bit about that in another webinar about the history of tax rates in the United States, the fact that we've been in this very artificially low tax system, but yet because of the national debt and a lot of other factors, that the likelihood of increasing taxes is pretty high. And just to make people aware of what that might look like and how that may impact you. So we'll talk about that in a future webinar. So the Buildback Better Act really comes down to in the areas we want to talk about. There's a lot of small areas described in this act that have certain emotional hot points, if you will, to certain sectors of the economy and the public. So we're not going to get into some of those. You probably heard about some of those recently in the press, but the areas we're going to focus on is more on the tax provision. So first area is how this is going to impact individual income taxes. We're going to also talk, there's some sweeping changes that are going to happen to retirement plans and how they're going to be taxed and what you can and can't do in the future. Capital gains taxes are being significantly changed. Matter of fact, with a retroactive date. So I'll mention what that is here in a few minutes. Talk about a little bit about estate and gift tax. So this may be an incredibly short window of time to get your estate tax planning done between now and the time that the new law takes effect. And then I'll mention a few changes that are going to happen to pass-through businesses, as well as the changes in the corporate tax structure. So the first area I want to tackle, or at least identify, is how this is going to affect all of our individual income taxes. So as of right now, the proposal is to impose a 39.6% top marginal rate for single taxpayers that have taxable income over $400,000 head of household. It's above $425,000, and for married filing joint, that tax starts at $450,000. So if you look at the graph on the left, you can see where we have the tax rates in 2021, depending on if you're single or a married filing joint. You can see where and most importantly, just where the 32% bracket then starts to be taxed at income starts taxed at 35%, and then at 37%. Under the proposed law, if you see the break of the bracket for the 35% rate, it stops then at a ceiling of 400,000. And then in the future, so for 2022, those taxpayers who are single that were in the 35% bracket between 400,000 and about 525,000, they're going to jump all the way up to 39.6% marginal rate. So it's a pretty big jump for them. Now the 37 to 39.6% may not be felt as much as the ones that are in that window of 35%. On the married filing joint, a similar situation is going to happen right around $425,000 of taxable income, whereas those people were comfortably in the 35% bracket. Now they're going to jump up to the 39.6%. So this tax increase is going to be felt a little bit more by the people in the 35% bracket than those that are already in the 37% bracket. But either case, it's going to be noticeable. If you happen to be one of the few taxpayers that have over $5 million of taxable income, there's going to be an additional 3% tax added onto that. So that'll put you in the 42.6% tax bracket. One of the things I want to mention here is a lot of our clients have explored this strategy in the past, and Congress and the IRS has had this on their list of items to start going after, and they've been successful in a number of cases, is in the area of conservation easements through syndicated partnerships. So that's where someone has bought into a partnership interest where they're then entitled to claim a charitable deduction. And because that property it qualifies as a conservation easement, which is then therefore a charitable deduction. So the IRS has been attacking those charitable deductions when they exceed 250% of the investment that the taxpayer makes. Well, the reality of it is a lot of these conservation easement valuations come back at 4 to 6 and sometimes even greater than that valuation. And the IRS has been more and more successful in attacking those. What Congress is planning to do here is actually amend the tax code to disallow any deductions that exceed that 250% of that investment, but not just going prospectively going forward, but retroactively to any contributions made after December 23rd of 2016. So there's going to be a lot of people who have claimed charitable deductions for conservation easements on the past 5 years tax returns, and that now they're going to be subject to an audit, and under this tax provision potentially lose that deduction that they had claimed, and therefore end up owing a lot of tax and potentially interest and penalty on that. So that's something that is got a lot of warning signs all over it, that anybody on this call that has entertained the idea of a conservation easement and or done one, just be aware that this is on the agenda under the House Ways and Means bill. Some additional changes that may affect some of the lower income taxpayers is the child tax credit is not only being that was increased is not just going to end this year, it's going to carry through to 2025, and so as the earned income tax credit for lower income taxpayers, and then the child independent care tax credit is going to also become permanent. And so some of those are very attractive. Now, where we deal a lot with the child and dependent care tax credit for a lot of our clients that are higher income is when that is offered as a fringe benefit to the client as an employee of their business. So these effects, other than the conservation easement being retroactive, all of these effects will start taking effect in 2022, including increasing that top marginal rate to 39.6. So the next area I want to talk about is how this is going to impact retirement accounts. So some of you on the call, this may not apply to yet, but we're looking at this over a 10 to 15 year time period. And so some people who have done a good job of saving for retirement are definitely going to want to pay attention to this potential new change. So the first change is that if you have over $10 million that you've accumulated in your IRAs and defined contribution accounts, so those are things like your 401k plan, your profit sharing plan, that exceed $10 million in value, if you make over a certain amount of income, so single or married filing separately 400,000, head of household 425, married filing joint 450,000, you will no longer be able to make a contribution to an IRA, whether it's a traditional or a Roth. So it's just out the door, no contribution if you've already accumulated over $10 million in those retirement accounts. Now, you can continue to contribute to other types of plans like SEPs, like simple IRAs, and defined benefit plans. But this relates to the defined contribution plans and the IRAs that you would no longer, IRAs that you just would not be able to continue to contribute to. So this definitely is going to change how people plan for their future retirement, because you're going to want to start being more strategic in what types of retirement plans you contribute to as you start approaching that $10 million limit. Obviously, then with husband and wife, that amount would be double that. The other important proposed change, is that if your retirement account exceeds $10 million, you're required to take out 50% of the excess every year. So it doesn't matter what age you are. So right now we have required minimum distribution requirements that start later in life when you have to start taking out an amount based on an actuarial table. But if you happen to be very successful in accumulating retirement assets and you're now over the $10 million amount, you're going to have to start taking out at least 50% of everything that that goes over 10 million. Now, added to that is another provision. So on the next slide, is once your retirement accounts your balances exceed 20 million, which again, these are pretty high numbers for a lot of people, but to think about that, just think about this over your career. Now you're going to have to take out 100% every year of anything that goes above the $20 million total value. And there's going to be a priority that you got to take out your Roth IRAs and Roth 401ks and other defined contribution plans first. So you're going to have to not be able to hang on to your tax-free retirement accounts and just live off of everything else. But actually, when you think about it in a practical sense, taking out the Roth IRA and Roth 401k, assuming you're over the age of 59 and a half, you're not going to be paying any 10% or early withdrawal penalty anyway, and it's already tax-free income. So all you're doing is you're just having to cash out your Roth IRA that you may otherwise intending to be leaving to family members. So the other important provision here is that what we refer to as the backdoor Roth conversion, that's going to be eliminated starting in 2022. So those of you who have done backdoor Roth IRAs, you've got a very short window of time to do that for this year. So if you haven't already done the backdoor Roth conversion, if you're over the income limit to open up a brand new or to fund a brand new Roth IRA, and your only option is a backdoor Roth IRA, you have until December 31st to get that done. In the future, starting after 2032, there's going to be a ceiling at which if you have over a certain amount of income, you can't do the Roth conversion anymore, period. So it'll phase out over the next 10 years. Another factor another change that could affect quite a few of our clients. We have a lot of clients that have opened up or started self-directed IRAs or Roth IRAs where they invest in gold, silver, closely held business interests, real estate. So the new bill is going to prohibit an IRA from investing in an entity where you own more than 10% of the interest, or unless it's publicly traded, or in an entity in which you're an officer and director. So you can still invest in privately owned businesses. You just can't own more than 10% of the interest unless it's publicly traded. So that's gonna shut the door on a lot of self-directed IRAs. Now, self-directed 401k plans are not part of this, so that may be another way to get around that new provision. So next, let me talk a little bit about the changes in the capital gains rate. So this is quite dramatic for a lot of people who are in a relatively modest amount of taxable income. So under the new provision, right now, if you have under 445, if you're single and under $445,000 of income, you are taxed. I'm sorry, if you're under 445,000 of taxable income, you're taxed on capital gain at a rate of 15%. If you're married filing joint, any capital gain between $80,000 and $501,000 in 2021, you're taxed only at 15%. Under the new proposal, if you have income over 400,000, so that's all income, including W-2, interest income, dividends, all of your capital gains, all capital gains, if your total income is over 400,000 now, is going to jump all the way from the 15% rate up to 25%. So those single individuals that have income between 400 and 445, which before that was only going to get taxed at 15% before you jumped into the 20% capital gain rate. Now you're going to have that 25% rate. So that's a pretty significant jump in capital gains. If you're married filing joint, same thing applies, where now they dip down to as low as 450,000 of total income. You're now going to be subject to that 25% capital gain rate. For those of you who have a partnership interest where you receive a carried interest in the form of, in exchange for services, the holding period for you to get long-term capital gain treatment now is going to go from 3 years to 5 years. So that applies to venture capital firms and hedge funds more likely than others. So most important piece of information on this page, besides the 25% new rate, is the effective date was September 13th, 2021. So that was when the House Ways and Means released their proposal for the Buildback Better Act. Unless you have a binding sale agreement on or before September 13th, any capital gain that you have or you recognize or incur after September 13th are going to be subject to potentially the higher tax rate. So we've already passed that window of if you've sold assets already, and they were after, or if they happen after September 13th, you're going to have to look at these new tax rates to calculate your tax. So that's one of the downsides of this, is that people were given very little notice, other than we thought there was going to be an increase in capital gain rates. At one time, it looked like it was going to be 39.6%. This bill is coming in at the 25% rate. So it's not as bad as originally, but the part that is retroactive now, and we don't quite know until this bill gets passed. There was another bill that proposed that the retroactive date was going to be back in April of this year for capital gains. So we won't know until this bill finally gets through the House and the Senate to know for sure which effective date they're going to use. So when it comes to estate and gift taxes, this is also going to be an area that people are going to have to take notice of. So starting in 2022, so we've got 2 months, 2.5 months to do things and put things in place if you are in this window of a taxable estate. Right now, we have an estate tax exemption of $11.7 million per husband or wife, so combined is over $23 million. That's going to be cut back down to just over $6 million starting in 2022. So that was originally going to be what the law became or changed to in 2026. So all they're doing is accelerating when that we revert back to the old estate tax exemption. In addition to that, the bill is eliminating a lot of the more popular wealth transfer strategies that we've been used to for the last several decades. One is the use of irrevocable grantor trusts to transfer assets from a wealthier generation down to a younger generation, and use these irrevocable trusts as a mechanism to do that. Another significant change is going to be that the discounts in how an appraisal is done for purposes of valuing those gifts of closely held businesses is also going to be eliminated. So that's been a very popular strategy that has been used. So again, you've got a short window of time if you're in that window of potentially having a taxable estate. Now, keep in mind that life insurance, if you own it or you have what are called incidents of ownership, life insurance proceeds are something that could be included in your taxable estate. So, and there's some ways to get that out of your taxable estate. So if you add up your net worth, add your life insurance to it, retirement plans, if you're hovering at or around that $6 million amount, you probably want to get a meeting set up as soon as possible with an estate tax attorney to get their advice on how you can reduce your taxable estate. Again, that's going to be effective January 1st of 2022, or whenever this bill gets enacted, whichever is earlier. So certainly don't want to wait and just assume that this is going to be, they're going to punt until the 1st of next year. So that's the effect on estate and gift taxes as it relates to pass-through entities. So this is in the area of partnership, ownership of partnership interests, or S corporations are another popular business entity that a lot of our clients own. So we've had a nice tax benefit under a tax deduction under Section 199A or Cap A, which is 20% of your net income from a partnership or an S corporation. You've been able to take that deduction subject to certain phase outs if you were in a specified service business. That's going to change. That's going to change to where that's going to be eliminated, subject to a phase out, if you are a joint filer with over $500,000 of income, or a single filer with over $400,000 of income. Another important change is going to be the addition of the net investment income tax as it applies to your net income that flows through from your S corporations or partnerships. So other than an inactive a business interest that you are inactive in, any active business that is an S corporation and or partnership is going to be subject to this 3.8% income tax if you're single over $400,000 of income, total or modified adjusted gross income, or joint over $500,000. So again, when you're thinking about what tax rate you're going to be in, you're going to need to add your marginal income tax rate to the net investment income tax. And if you're subject to a state income tax, all those together when it comes to deciding how this is going to impact you. There is going to be a window of time, which may be a good opportunity for some S corporations to rethink whether they need to be reorganized as partnerships. Typically, when a S corporation converts to a partnership, for tax purposes, that's treated as a deemed distribution, which is a taxable event. But we're going those S corporations are going to have a window for 2 years to reorganize as partnerships without having any that be treated as any taxable income. So there's going to be a revolution of corporate or choice of entity evaluations on whether or not you should stay as an S corporation, or whether there's another type of business entity that you'd be better off being in. So that's the effect on pass-through businesses. Now, the last area I want to talk about is how this is going to affect corporate taxes. So we've all been hearing about the new tax rate for C corporations or taxable corporations is going to increase to 26.5%. That's actually it's actually a progressive tax that we're going to that this bill proposes. So right now, in 2021, we have a flat corporate tax rate of 21% for federal purposes. That was changed back in 2018. So before 2018, we had a progressive tax rate that started at 15% and went up from there. So that changed to the flat 21% tax rate starting in 2018. So that's what we've had for the last several years. Under the new proposal, we're going to have a tax rate that starts at 18% for the first $400,000 of taxable income. Then it'll jump to the 21% rate, which we have now, up to $5 million. And then you won't have the 26.5% rate until you're at the $5 million taxable income. Once you're over $10 million, there's an additional 3% tax. So it's the lesser of 3% of taxable income over 10 million, or $287,000, whichever is less. So you're for those bigger corporations, the tax rate's actually going to be higher than the 26.5% potentially. Where this ends up being an excellent planning opportunity, especially for most of our clients, is the ability to shift income by having both an S corporation, as an operating entity, and then also a C corporation that operates another business. And that allows you to, by having certain relationships between those entities, you can shift income from potentially that higher tax bracket. So if you're in a 39.6% individual bracket because of that S corporation, you might be able to shift some of that income down up to that $400,000 limit down to 18%. So what we have typically done with clients in the past, where we have shifted that down to 21%, now has actually gotten a little bit more attractive because that rate could drop to 18%. So just keep in mind as you're doing tax planning, make sure you're looking at the type of business entities you have, and perhaps adding one or more types of business entities, just so that you can take advantage of some of the different tax brackets. So moving on, and one more thing about the corporate taxes. So there's several other areas that affect corporate taxes. Most of our clients don't deal with some of the offshore and foreign taxable income provisions that are part of this bill. But if non-resident aliens are going to have a 30% withholding tax requirement for any interest that they have in a company where they own at least 10%. The carried interest, like I mentioned before, the holding period is going to go from 3 to 5 years to get long-term capital gain treatment. And then one of my favorite tax strategies for clients who are approaching a point in their business where they're planning to exit their business or sell it to employees or someone else, is taking advantage of this code section 1202. In 2018, it was amended to allow 100% of the capital gain, if you were a qualifying small business, on the sale of stock, you could avoid capital gain on up to $10 million of capital gain of gain. So that became a very attractive strategy for those clients who had the opportunity to sell. It had a 5-year holding period, so you had to start the clock ticking if you plan to sell within 5 years. Well, under this new proposal, those are going to start being phased out if you're for those who have adjusted gross incomes over $400,000. So again, that we had that window of time. It's still an attractive strategy for those who have under that taxable income number, but it's going to be phased out under this new bill. So Tyler, what do we have next on the agenda? Okay, good. This is the fun. This is the next fun part, which is now what's potentially going to be happening over the next month or 2 months. So let me give you at least a lay of the land as far as what we understand it to be. So keep in mind that this Buildback Better Act just came out of the House or the Ways and Means Committee. It's now in front of the House, has not yet gone to the Senate. So the House has first got to vote on it and debate and negotiate it. And there's a lot of negotiation that's going on. So it's not been voted on yet. The House attempted to pass the bipartisan infrastructure bill, but that's been stalled because of the negotiations on the Build Back Better Act. So as a result of that, no bill was voted on yet on the bipartisan bill. And what it looks like is, these two bills are going to be tracking along, and they've got to first be they've ultimately got to be negotiated and approved by both of the House and the Senate. So there's a lot of negotiation that obviously still has to be done. So what we're giving you is what the House Ways and Means Committee has proposed. It's certainly a long way from becoming law. So just to tell you where these bills are right now. So the infrastructure bill passed by the Senate back in August. It's sitting in the House right now, waiting for a vote. The Build Back Better Act, it's in the House. Or the Senate basically is waiting for the House to pass it. So it just came out of the Ways and Means Committee. That was introduced back on September 12th. So that just tells you where these two bills are right now. What we are speculating, so again, this is what we read from a lot of different places that we try to find this information, is this capital gains tax rate is still in motion. Originally, it looked like it was earlier in the year, it was going to be up to 39.6%. Now it looks like out of the Ways and Means Committee, it's going to be down to about 25%. So potentially somewhere in that range. We don't yet know if that retroactive date is going to be back in April under one bill that was proposed submitted then, or it's going to be that September date. So for those of you who have high taxable income and could be in that higher tax bracket, just be mindful that if you haven't already sold your property, you're going to be probably subject to that higher tax bracket because of one of those two retroactive dates. Corporate income tax rates could hover or end up landing somewhere between 25 and 28%. The top individual rate looks like there's bipartisan support for that to go up to that 39.6. There is talk about removing the step up in basis. So at the end of your lifetime, the fair market value or your tax basis of property that you own at the end of your lifetime gets stepped up to fair market value, so that when your heirs sell that property, they don't have to pay capital gains tax on that. There's talk that may come back to where that's only going to be limited to gains up to $1 million, and then eliminated for assets above that or net worth. And then, like I mentioned, the carried interest that looks like it's settling at around the 5-year mark. So that's probably where things are going to end up in those areas. The net investment income tax, that looks like that's going to settle at about that extra 3.8% is going to be applied to individuals for S corporations and partnership income, somewhere with individuals, single individuals over 400,000 and married filing joint over 500,000. There definitely looks like there's bipartisan support on capping the Section 199A to 400 to 500,000 of income, and then depending on where the corporate tax rate ends up, we could still have a minimum corporate tax of at least 15% that applies to some of the larger corporations. So those are a couple of other things that we could see. Now, there's, like I mentioned earlier, there's the ultra millionaire tax bill act that was submitted or proposed back in the spring. It's in both the House and the Senate. But one of the things that it mentions is the introduction of what is described as a new tax on wealth. And so this is right now we have an income tax, generally speaking, that people pay on their income every year. And then we have an estate tax on the value of your taxable estate at the end of your lifetime. This new type of tax could be a tax on your wealth during lifetime based on the value of the assets that you have. So the rationale and how this system could come into play is that real estate holdings, generally you know what the assessed value is through knowing what your property values are. Publicly traded stock is obviously valued at fair market value. So So there is data out there that would allow the federal government to be able to track and monitor what someone's net worth is. So on the next slide, where this, I'm sorry, I guess that was, I had another slide that I was potentially going to add. So just be careful, or just be mindful that there may be another tax around the corner above and beyond what we've already talked about with income tax and estate taxes, if that's not enough. That may be an annual tax on net worth for ultra wealthy. And we don't know yet what that ultra wealthy amount or that number is going to be, that people are going to be subject to that. So just real quickly, and again, these are very high level, 30,000 foot view concepts. We're going to drill down to these every time we have a webinar and get more detailed with specific recommendations and with some examples of how each of these and additional ones may help you as we know more about what these tax law changes are going to be. So just keep in mind that normally you want to defer income, especially if your tax rates are high this year and they could be lower in the next year. In this new regime that we're moving into, you're definitely going to want to know what your potential tax rate is going to be under the new tax law. Can try to do all of the tax planning you can in the current year, and then determine, does it make sense to push that income push that income into the current year if you have the ability to do that. So if you're in a business that allows you to accelerate that income or to take that bonus or whatever that is, go ahead and take the income this year because you know you're going to be in a lower rate. The flip side of that is it may be better to defer deductions. So a lot of times everyone's scurrying around to try to find write-offs that they can take advantage of for the current year. You want to be careful to do that if your tax rate's going to go up next year, because that deduction may be worth more by waiting to take that deduction in the year you're going to be subject to that higher tax rate. And to the extent that you have already sold property before one of those retroactive dates, you definitely would have been, you'd be better off if you had accelerated that capital gain into this year versus if you're subject to that 25% rate next year. The fourth item that we'd like to mention is, again, this is a more detailed analysis than what we're going to talk about today. Make sure that you're looking and evaluating potentially utilizing a C corporation somewhere in your business if you don't already have one. The only exception to that lower 18% tax rate is if you're a personal service corporation, which was on the slide before. I forgot to mention it. Those personal service corporations, which that's been defined, in past tax law, you're going to be taxed at a flat 26.5% rate. But all other C corporations would have the benefit of that lower 18% rate. So if you can set up a business that you can also have, in addition to your S corporation or partnership, that is a C corporation that's not a personal service corporation, that should definitely be considered. Probably the biggest and most important thing for those of you who have been successful at accumulating wealth inside of retirement plans, just be mindful of that new ceiling and or the ability to convert some of those retirement accounts that otherwise you've kicked the can down the road and you're going to pay ordinary income tax when you retire. You may not want to let that continue to happen, especially if you're getting a tax deduction today at a lower rate, and you're only going to be kicking that can down the road when you're going to have to take that money out at a much higher rate. So definitely looking at converting some of your tax deferred into tax-free, i.e. a Roth IRA or a Roth 401k, is something that has been very popular this year and will become extremely popular if this bill looks like it's going to pass. And then the last one, which definitely we always recommend to anyone who is not working with a proactive tax planning firm, is get a proactive tax plan in place that takes into account all of these proposed changes, so that you can see what all the options are with or without this bill passing by the end of the year. If you work with a firm like ours, we start with what we call the strategic blueprint, which Tyler mentioned earlier, and I'll let him go over what that looks like in the next couple of slides.
Yeah, like we said, this is our process. It starts with a strategic blueprint. What we do is we look at your last 2 years of tax returns, and we have you fill out a questionnaire. And from that, our tax experts give you some recommendations and give you a look 5 years out of what it might look like if you implement these recommendations. From there, if you like what you see in that strategic blueprint, we would love to have an engagement with you, and that starts with onboarding, a great educational session where we kind of teach you along the way and we exchange some information to get the job done. We also go through our model, the implementation of it. Ooh. And of course, we have the quarterly pulses that will keep you in tune with the changing tax picture. There's two ways really to get started with this. If you're not ready to jump into that strategic blueprint today, you can always give us a 30-minute Zoom call where you talk directly to our team and they'll explain a little bit more about how we do what we do. That's a good way to get started. But being the end of the year, the way to go really is a strategic blueprint. We figured out today, David and I, that we think we can only accommodate 50 blueprints by the end of October. It takes some time for our team to do to run the numbers from your tax returns and the questionnaire. So I would definitely hop on this offer, and I will put those links in the chat while we're doing the question and answer session. It's $1,250, but we guarantee that we'll find 10 times the savings of the cost of the blueprint. Let's see. Big news is that we have 3 upcoming webinars that are kind of all in this realm of all the things that are going on in Washington. We'll cover some more things that we weren't able to cover in this webinar 2 weeks from now on October 20th. Part 3 will be a year in tax planning for businesses. That's the very first week of November. And then 2 weeks after that, we will do tax planning for individuals for the year end. So questions, we had 1 come in from the chat and 2 from the Q&A sessions. And for David's reference, they both came, or all of these questions came in from the Build Better Act material. First one is the estate tax limit of $6 million for couples?
So that is per individual. So just like the 11.7 million, which is a per individual, husband and wife each get their own separate exemption. That also applies to the $6 million limit. So it'll for a married couple right now that'll be $12 million.
All right, and some more. Is there a time limit when we can do Roth conversions from our pre-tax to Roth 401ks since taxes go up next year?
So the taxable event is when you pull the money out of your pre-tax account. So that's when the clock starts ticking. And that's when that determines what year that is now going to be taxable income. So before you do a Roth conversion, you're going to want to first calculate what your potential marginal tax bracket is going to be this year, because obviously that's going to increase your taxable income. So there's some math that has to be done where if you're in a lower tax bracket and you want to and you only want to convert enough that you don't bump into the next higher bracket or 2 higher brackets, depending on how low you are, compared to what you think your tax bracket's going to be next year, and what you think your tax bracket's going to be when you retire and start taking that pre-tax money out. So it's all part of a calculation that needs to be made. There isn't a one silver bullet answer. It's an analysis that you have to go through to really determine what kind of tax you're going to be exposed to this year if you do a conversion. So that, just to answer that question, if you do, when you take that money out of the Roth or the pre-taxes, that's the year you take that out is when it's going to be taxable income.
All right, on to the next one. And just for your reference, David, another one has come in after this one. Is it a good idea to do Roth conversions from our pre-tax profit sharing plans to Roth 401ks if we can afford to pay the taxes from a taxable account?
Yes, so that's usually the best, because if you're under the age 59 and a half and you don't convert 100% of what you take out pre-tax, you're going to be subject to that 10% early withdrawal penalty. So ideally, if you can pay the tax out of another source of funds and roll over 100% of your pre-tax, you'll potentially avoid that 10% amount, and you'll have all the more of that money rolling over into something that's going to grow, hopefully in the future, tax-free. And the last question is, should you or is it wise to try to maximize the current estate tax exemption, which is $11.7 million per person before the end of the year. And I would say that if you have a large or anticipate having a large taxable estate, it absolutely makes sense to to consider what type of estate tax strategies are compatible or meet your estate planning objectives. And obviously, every family is going to be a little different. But if you just look at at being able to shift that wealth with that higher exemption before it goes away, it goes down to $6 million this year. That I definitely would advise talking to a competent estate tax attorney about getting that in place. And then the last question is a captive insurance company a good idea? So there's been a lot of press about captive insurance companies because of some abuses that are out there, and some business owners treating them like a personal checking account rather than as a true risk shifting device, which is what the tax law originally intended. So the IRS has been making a point of going after a lot of the abusive ones. Unlike the conservation easements, which have been generally under a lot of attack, captive insurance companies are still within the boundaries of the tax law if you play by the rules. So I'm a fan of captive insurance companies if you're willing to treat it like a true insurance company as a risk-sharing vehicle. It is a very attractive tax planning strategy that allows you to deduct the cost of the insurance premium that you pay your insurance the insurance company that you own, and then worst case scenario, when you no longer need that company around and you liquidate it, it now is subject to only long-term capital gains treatment on the back end. So captive insurance companies are still popular. They're alive and well. If they make sense in your overall estate tax or tax planning strategies, I would definitely consider them. So those are some good questions. We got some potentially heavy hitters on the call today. If they're asking questions about the $11.7 million estate tax exemption and whether captive insurance companies still make sense.
Yeah, one last question come in just now. Is FLLP a good idea right now?
So limited partnerships, and as the name implies, a family limited partnership or limited liability partnership, as a wealth transfer strategy, has come under quite a bit of attack in tax court cases over the last probably 7-8 years, maybe a little bit longer than that was when the cases started. So they're still popular. They have become less popular because of some of the restrictions that you have to put in place to make sure that you're successfully transferring that wealth that you're trying to gift via the limited partnership out of your taxable estate. So it's not a one size fits all, and there's definitely more landmines there than they have been in the past that you just may be mindful of. So again, working with a successful or a competent estate tax planner, estate tax attorney would be the best first step, just to make sure that you're aware of what limitations you're going to have to be subject to in order to use that strategy correctly.
Oh, we have one more if you're ready for it, David.
So opportunity zone investing, a good idea given the current situation. Wow, that's a loaded question. Well, if I was looking at a crystal ball and I thought real estate prices were going to be going down in the near future, which there's a lot more talk about that potentially being the case, opportunity zone properties, for the most part, are properties that are located in less desirable areas. So logic would have it, and again, I'm not selling anything here other than my personal opinion, is that if the economy and the real estate market did slow down, it would probably slow down first in the less desirable areas than the more desirable areas, and that's where most opportunity zone property is. Now, with that said, opportunity zones are a long-term investment strategy, aimed mostly at deferring the capital gains on property that you're selling today that you're not otherwise going to do a 1031 exchange or something like that with. There's other tax or capital gain mitigation strategies other than opportunity zone that you should probably look at, rather than potentially be forced to make an investment in less desirable real estate just merely to try to avoid capital gains. Wow, there's some really good questions. So, but what I'm celebrating is the fact that we were able to pull this off, Tyler, in just under an hour. So we gave enough time for some questions and answers. Try to stay on cue with all the topics. Again, this is a step-by-step process that that we're going to take people through who are willing to participate in these webinars. Try to make them very informative, very relevant, very timely, especially as this this legislation continues to evolve in the House and the Senate. Oh, Tyler, you muted yourself, but
Sorry about that. I just wanted to say thank you to everyone who came out tonight and viewed the webinar or maybe saw it on replay. Make sure and stay tuned to your email for some communications on future webinars, and we'll always be out there on Facebook and LinkedIn. So if you want to follow us there, that'd be great. I guess we end this with thank you and have a great night.
Great. Thanks, everyone. Thanks, Tyler.